Mm. Wow. All right, well, I guess this will be it for today. Salute, folks. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, your social media insurance broker. And I've returned today to weapon tap on your head with another ADH wealth solution. Before I go in, ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So, as you guys can see, today's topic is going to be study with me, because when I get back into my house, I'm going to go live. Well, go continue going live from my laptop or my computer in the house, um, with y'all over the aspect of my studies. My studies is me doing continuing education, which is something that when you have licensure and things, you have to do, depending on what field you are in. Financial services, depending on which license it is, either by the December 31st of each year or by your birthday every 2 years, you need to renew your license. Kind of like your real estate license, your tax license, or your licensures. Usually, once every 2 to 5 years, you're going to have to renew. What's going on, Wanda? So I'm going to take y'all with me this morning while I do my little morning ritual walk. I was going to go and get a useless tobacco product, but now I see that I got my people watching me and y'all are helping me with my willpower and strength. So thank you for that comment, Wanda, because now that I'm cognizant that you're watching, it's sometimes you have to have those mind tricks and willpower, and everybody uses different things for help. So thank you, Wanda. You've just helped me to realize that spending $1 on this tobacco cigarette, which is just a habit. I need something, not need something, but normally I have a habit where I put something to my mouth while I'm outside walking, and that kind of defeats the purpose of the walk, which is to get your blood pumping and get your health right. And if you're just huffing on a cigarette, it's kind of it's doubly waste, right? It's a waste of your health and your money. So that's not the purpose of this. Now, nobody is perfect, right? I'm not perfect. Nobody is, which is why we're doing what we're doing. But again, thank you, Wanda, for just kind of being there to see me. What's going on, Chief? And how we're doing. So I will be taking you guys with me shortly once I finish my walk to getting on the computer and doing more continuing education. This is something that I have to do to keep my licensure, because that's how I provide my livelihood. Sure. And this is something that you want to be aware of often. I speak to people all the time who are like, hey, when I talk to them about insurance, or even when I did real estate, and I would talk to people about real estate, oh, I had my license. Well, great. I'm glad you had your license. Do you currently have your license? No? Well, let me tell you, since you've had your license, unless you had your yesterday and you don't today, some things have changed since the last time you've had your license, because there's continuing education. So yes, a lot of principles do remain the same, but things change. And as you stay inside of an industry, not only is it that things change, but you end up learning more about the industry, the ins and outs, the ups and downs, the lefts and rights. Prime example, you'll have a lot of financial professionals, especially online, who know nothing about stock, except for the studying they do, and then they have these channels talking all about stocks and investments, but they don't know the nuances. You might know, oh, VOO, QQQ, ABC, but there's a lot more nuance to it than that. What do I mean? Well, let's use it in terms of something that is very common and practical that most people would assume they don't need, a super amount of training for. Let's use something universal like cars. Well, if the last vehicle that you've driven is, over 10 years old, there's a lot of technology that are in cars now that wasn't 10 years ago. Right? Does that mean that the rest of the car doesn't function the same? No. But if you were to get into a 2024 car versus a 2014 car, there's a lot of functionality that you probably wouldn't be aware of. Right? That's just kind of how it works. Good morning, sir. I don't have any money, sorry. So, there's a lot of different uh, 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 aspects of each thing that will change. No, I shouldn't have been that mean to that guy, but I see him every day asking the same thing. Hey, can I ask you a question? Can I ask you a question? Do you have a dollar? Bro, I'm not doing all that. And these are channels like ours, me, Wanda, Sheed, stuff like this. We're doing this so you don't end up in that predicament. Especially young black men. I grow so tired of seeing us out here every day, sitting here, having the nerve to ask a guy who walks past me, hey, can I get a dollar? While I am sitting here in financial services. I do the same thing. I beg people for money. That's what you do as a stockbroker. You beg people for money. But if I'm going to beg people for money, I'm going to beg people for big money and make it impactful. I'm not going to sit here and beg somebody who's making a regular salary every single day that I see them, hey, excuse me, can you help me out? Hey, excuse me, can you help me out? No, because that person is probably one paycheck away from being out there asking you to help them out, right? It just happens like that. Now, am I mean? No. But after a while, it gets a little old. So you do what you do. But anyway, how you doing this morning? I don't. So, in those instances, you tend to be that way. But those are very simple things you can do to actually put yourself in good predicaments. Thanks for your service, sir. And she says, I was lost for a minute with the keyless car start. Used an actual key forever. Yeah, and but those are small things in different fields that change. So even learning further about your craft, right? Or even learning further about the vehicle you have. Prime example, um, even in the technology, right? So, for example, I drive a Mercedes. Well, in Mercedes, the technology of automatic door opening and stuff, like the keyless entry, that's been around since 1998. So, since 1998, you've been able to have keyless entry on a Mercedes. But if you put it in a Honda, that's 2024 technology for a Honda. So, if you have a 1998 Honda, you ain't got keyless entry, right? But a 2024 Honda does. But it took almost 30 years for that to happen. Spawn, what's going on? So that's the purpose of retraining. It also, good morning, gives you more knowledge into your field itself. Let's use something like athletics, right? And we can use this as the prime example. Oh, hey, I used to play basketball, right? People used to love basketball in the 90s. Well, basketball in the 90s, it's the same game, right, in 2024, but the rules are a little different. It's played different. People, oh, the Jordan era was tougher. Oh, this era was that era was that. It's still the same game, but the things have changed. Rules have nuanced. And, because of XYZ happening, ABC happens in the future. So just like Jordan probably wouldn't translate exactly the same way in today's NBA, just like LeBron probably wouldn't translate the same in Will Chamberlain's NBA. But as you learn and progress in the game, yes, you get better. You learn how to maneuver athletically to be at the top of your career. And the best of the best are the ones who do that, right? They don't just start off and a phenom, and that's the end of it. They practice their craft and they're obsessive over it. LeBron James, Michael Jordan, Kobe Bryant, they were obsessed with the game. And that's why we consider them the greats, right? It's not because they're just great and they outperform everybody. They outperform everybody because they outstudy and out hustle everybody. So it's the same thing when it comes to this financial services. I have to outstudy and out hustle everybody. Now, like I said, soon I will be taking y'all upstairs with me so that I can hop on the computer. I just wanted to do a quick little 10-minute walk to get my blood pumping because health is wealth and health is one of the things that we need to have taken care of. So now I am going to bring y'all upstairs with me, hop on my computer and, like I said, do some of this studying because I think it's important. Most of the time, a lot of stuff is that's actually on the licensure exam. And I'm a designated person. I actually had a relative of mine call me up. My name is Snoop in Brooklyn. And he called me like, yo, why is it that you guys you don't do like TikTok and all this stuff? He actually came to me recently because he saw some stuff about life insurance on TikTok, and then he was going to do a consult with the person on TikTok, and he was like, "Wait, I know a person who sells life insurance." That was me. So he came and he reached out to me, and he was like, "You still doing life insurance?" And I was like, "Yes." And so we got together and we did the life insurance policy together. But recently he calls me and he goes, "Yo, Lonzo, there's these people on Instagram and TikTok and Facebook, and they're doing." So he was like, "Well, TikTok, hey Queena, she what's going on?" And he goes, "Listen, I don't know why you not, but it's mad people who are doing classes and they're charging like $75 for these courses." And he said, "Listen," I said, "I don't really like to do the courses. I don't like to charge money for this, that, and the third." And that's really from my old school training because today everybody it's like college, right? People pay money to get the knowledge from college. Well, listen, I've got this actual knowledge and it's valuable and I might as well use it, right? The thing is, I personally I just don't use courses, but he says, "Listen, you should start doing courses." So shout out to those who were at my last webinar. I'll be doing another one again this month. I'm gonna start doing a lot more webinars. Hopefully I'll found something from it. Sheet, I think you were there. I'm gonna be honest, I don't remember who all was there, and who wasn't. I have my list, so I will check the list. And I got emails to send out to all of y'all. I had a little health issue that I had to deal with, that slowed me up a little bit. But with hey, business content, what's going on? Um, but now that I'm getting back into the swing of things, it there's I have to. It's just it only makes sense to do that. That's all right, business connections. I intend on having a whole host more. I intend on having a whole host more of these. Because I 1 second. Okay. I intend on having a whole host more of those. Just for the simple fact, wow, I had to set my setup up. Just for the simple fact, I think it was a kind of a good thing. And like I said, it built it builds camaraderie, to answers questions and things of that nature. Now, and y'all can definitely appreciate. Actually, I want to thank K Business Podcast or Business Connections for that. And if you haven't followed him, make sure you follow him. He's actually, I think Sheed may have been one as well, who are also in terms of my relative telling me specifically, "Alonzo, the knowledge that you have, you should start charging for these webinars." Right? I know Business Connections was like, "Bro,
you got to charge money for this. Like, you're giving this great information, and it's it's crazy cheap, and you're not charging people money. And he was like, I'd pay for it. I'm telling you, people will pay for it. And so I may start doing some podcasts, some webinars that I charge for. And y'all will be privy to that. So yeah, thank you, Kay. Because Kay is about business, and Kay said, "Listen, this is business, Alonzo. I'm thankful that you're willing to give me this knowledge for free. But at the end of the day, you as a man have a wife and a family to take care of too. And for business, you have to start charging." And that's what he said. You got to start charging. That was it. um so thank you, Kay, for making me realize I'm not going to start charging yet, but I will be charging. And there are people charging $250 for their webinars, and they don't know one quarter of one iota of a quarter of the knowledge that I have. But they've been given a little bit of something. So as I said, I'm going to have y'all study with me. As y'all can see here, it's total access. So we're going to launch this, and I'm going to do some further studying to renew my license here. So again, this is Know Your Customer. So before I go there, I want to show y'all something. Let's share screen. We'll just do the entire screen really quick. I just want to go to Google, right? Just what is the KYC rule in? Okay, what is the Know Your Client rule? Just so you guys know what KYC rules are. So KYC, Know Your Client, is something that you should know, that your financial professional should be familiar with, because FINRA Rule 2090, Know Your Customer. This is the primary FINRA, Know Your Customer rule. It states that any financial institution, when opening or maintaining a client's account, has to exercise reasonable due diligence. So what does that mean, ladies and gentlemen? When you're sitting down with me or your life insurance guy, and he does stuff like this, and he says, here, I'll do this one. And he says, hey, listen, I need your name, your address, your date of birth, where you're from, your assets and liabilities. And you're like, what does this have to do with life insurance? It has to do with us being compliant with the law and making sure that we know our client, because we have to determine certain things about it, right? What is the main purpose of the Know Your Client rule? All right, here we go. KYC, what it means, compliance, right? So, Know Your Client is a standard in the investment industry that ensures advisors can verify a client's identity and know their client's investment knowledge and financial profile. So all these people who come online and are like, my name is John J. Stocks, and this is, Stocks with Larry, and then they tell you that bullshit. This is not financial advice. Well, it is financial advice, because it's called implied, right? So they're implying that they're investing in this, and maybe you should too, right? So let's see here. 3 components of KYC include CIP, CDD, and EDD, right? So that was enacted in the USA Patriot Act of 2001, right? So key takeaways are that the Know Your Client is a standard used in the investment and financial services industry to verify customers and know their risk and financial profiles. The reason you can't go investing willy-nilly, and it sounds nice, but it generally doesn't work out for people when you're investing off of what your buddy Bob did, because you and Bob don't eat the same foods. The way you digest 4 scrambled eggs is not the same way that Bob digests 4 scrambled eggs, even though they're cooked exactly the same way by the same person. Your body and his body are different. So your financial goals and his financial goals are different. Even though you both want to go live in Colombia for the rest of your days, you don't want to live on the same island in the same house together. Does that make sense? So it's the same thing, right? So you've got the 3 components, which are customer identification, customer due diligence, and enhanced due diligence. And the SEC requires that each new customer provide detailed financial information before opening an investment or banking account. Okay, so now let me just check the chat here. I'm going to stop this screen. I'm going to share back my screen with the actual, what is this? Town and country. Did he sign this? No. All right. I'll get him to do that in a second. Close this out. Delete. Fish emails. All right, here we go. And let me share my screen with y'all one more time. Present, share screen. All right, so now we're going to go back into, again, know your customer and variable annuities, FINRA 2330. The other reason that having a financial professional, depending on their length of time in the business, is important, and this is a lot of the bullshit that be happening, because a lot of these fake ass advisors come up in here from Primerica, Family First Life, people helping people, Experior Financial Group, World Financial Group, Transamerica, all these bullshit, FFL, and they build teams. Listen, these people haven't even renewed their license 2 or 3 times. That would be equivalent to saying I took the best basketball player in high school. Let's take LeBron James out of it. Even though if LeBron James in high school, when he came to the league, he wasn't making the decisions or choices he is now. Yes, he was put right on the on into starting and propelled straight out of high school, but he wasn't thrust into le GM, as they say, right? Yeah, they knew he was a transcendent talent, but they didn't understand that he understood the game. He knows how to coach now. But if you put him straight out of high school into coaching, it would be a disaster. Now that he's played for 20 years, it seems like he's been coaching the whole time. And people are looking back retrospectively, and he was able to break down the game. But that's because of the study. Let's look at another person who was like that. Kobe Bryant. When he came straight out of high school, he was a phenom, but he got better with time because he studied and perfected his craft. Now, let's look at somebody who came into the game and was extremely hot and fizzled out fast. Let's look at somebody like, I'm trying to think who came in hot and fizzled out fast. Greg Oden. Maybe he can coach now because he hasn't played, but he studied the game. But if you would have took him straight off of Ohio State court and been like, listen, you're going to get an injury, so we're just going to draft you to be the head coach, he wouldn't be doing that great of a job. So it's the same thing. How are you going to expect Lamar Jackson? Well, no, he was good. Lamar Jackson is good, right? But imagine him coaching or trying to make the decisions. It wouldn't have been a good thing. So yeah, Business Connections, you're absolutely right. Imagine Tom Brady when he when he first started, and Bill Belichick giving him the reins like he did after 3 and 4 and 5 years of doing it. And that's what these people who are at World Financial Group, or people helping people, and all these, actually Business Connections mentioned. There was a guy who tried to recruit him for insurance, and did all this, that, and third, and took him out to dinner, and then couldn't even pay his own bill. I have people who reach out to me all the time. Hey, I see you're in the insurance industry. Hey, I run a team of 100 agents. Listen, take me right now. I just got a Mercedes, right? I just got a Mercedes last year. I like Mercedes. I study Mercedes. But take me with the knowledge I have of Mercedes right now, and let me go run a Mercedes car dealership. It's not going to be a good thing. Now, if you give me some years of training and practice and development and working at the car dealership of Mercedes and working under GMs and learning under them and learning how things work, then after 4, 5, maybe 10 years, I can go ahead and go into that. Give me 1 second here. See who this was. Someone just called me from Texas. But then you can actually go.
This pre-approval is not based on your personal credit score, and rates start at a 4.9%. If you are interested in speaking with an account executive, please press 1 now. If you please hold. Your call is being transferred with no wait time.
So this is funny. I just got a call from a spam call about my business.
Good morning. How are you today?
Hi, how's it going? All right. Yeah,
Assuming you're looking for additional capital for your business.
well, yeah, I got this call that I guess stated based on my DMB number.
Yes.
Okay. Yeah, I don't have a DUNS number. I'm a financial services institution, so I wouldn't be a good candidate for cash advances.
All right. Cool. I'll take that list.
Thanks. Have a good one.
You too.
Bye-bye. So luckily, that's also, again, I have been in the financial services world for almost 20 years now. And when I say financial services, I mean everything from doing taxes, being a bank teller, doing business to business cash advances, which is why I just called these guys back. Like, how are you calling me based on a Dun and Bradstreet number that I don't have? I don't have that kind of services. I am a financial services industry company. I wouldn't need a cash advance loan, but you get put on the list when you register your business. It's what happens. So, where was I here? Let's get back to my screen here. All right. So, we are going to continue with the Know Your Customer and variable annuities from FINRA. So, this gives me 3 hours of my continuing education credit, and I need 32 hours. So let's continue. Start course. Now, a lot of this I know already, so I'm not going to like be going over it with y'all. I might, stop and take a test here or there, get it wrong on purpose, just to kind of, go over things. But this is basically, it tells you about, see, this unit will introduce you to the characteristics of variable annuities. Let me see if I can make this a little bigger. Yeah. So this unit will introduce you to the characteristics of variable annuities and provide examples of how they are used to manage certain types of risks. You will need to spend some time understanding the basic provisions, regulatory requirements, and the riders of the various types of annuity transactions to be fully prepared to comply with annuity suitability rules. This foundation of variable annuity knowledge will need to be applied to the next units, which specifically states the requirements that are necessary for representatives to comply with FINRA Rule 2330. All right. So as you'll see, this is for registered representative training use only. So now, before I do that, let's do this. What is a registered representative? Right? Because you guys don't know that. All right. So let's go to Google and see. What is a registered representative? Okay. Registered representative, definition, job, description, and pay. So who is an RR or RIA? A registered representative is a person who works for a client-facing financial firm such as a brokerage company and serves as a representative for clients who are trading investment products and securities. Registered representatives may be employed as brokers, financial advisors, or portfolio managers. Registered representatives must pass licensing tests. So if anybody up online tells you, hey, I'm your stock guy, I'm the guy who's going to be dealing with your stocks and and they're not a registered rep, they are not the truth, because they have to. In order to, it's just like in order to be an NBA basketball player, you have to be drafted by the NBA. You have to be signed to an NBA team. Otherwise, you are not an NBA player. You might play basketball, but you're not an NBA player. Okay? Must pass licensing tests and are regulated by the FINRA, Financial Industry Regulatory Authority, and the SEC, or Security and Exchange Commission. RRs must furthermore adhere to the suitability standard. An investment must meet the suitability requirements outlined in FINRA Rule 2111 prior to being recommended by a firm or investor. So if anybody, and I don't mean to pick on her, there's a young lady who I like who talks to a guy named Larry Holmes, but he's a fake. And unfortunately, I have to call out the fakes because even if it's not your intention, you're making my job harder. That would be like people who aren't doctors running around prescribing medicine online, and then when people die, well, there's nothing that can be done about it. And almost the same thing goes with real doctors, right? So, there are people who will be up here and they're talking about stocks, and if you're not registered, please stop, because you're doing more harm than good. The following question must be answered affirmatively. Is this investment appropriate for my client? Which is why you'll hear people like Larry Holmes tell you that you can't, that it's not financial advice. A registered rep is a financial professional who is able to deal with client transactions in the securities market. Registered reps must pass the Series 7 and 63. They also have to uphold suitability standards. Okay, now we're going to go back to the studying, because like I said, I want you guys to study with me. Let's do this. Bronze, what's going on? Present. And so a lot of this stuff I'm going back and forth because, this is valuable information. So fixed annuities. Under traditional fixed annuity contracts, the insurance company assumes the investment risk. If the investment performance is more than what is required to fund the contract's guarantees, the difference is added to the company's surplus. If investment performance is unfavorable, the insurance company, not the contract owner, bears the loss. As a result, fixed annuities are not considered securities. Therefore, it is not necessary to obtain a securities license to sell a fixed annuity, since they are not regulated like a security. Fixed annuity producers are only subject to state insurance regulation. Now, why is a fixed annuity important versus a variable product or a non-fixed product like an investment? Well, a non-fixed product or a non-fixed investment or a non-fixed annuity means that it has those characteristics where instead of the insurance company bearing the brunt of the loss, you, the insured or the purchaser of the investment, bears the brunt of the loss. Give me 1 second, y'all. I gotta go get me something to drink, and let me turn on a little quick music right quick. While I go get me something to drink, I'm gonna turn me on some good mood music, because I didn't play my mood music this morning to get y'all in here with me. So let's get that going. I'll be right back. I just gotta go get some water. Yeah. 2 minutes, y'all. I gotta take a human intermission. 2 minutes. Oh, and there goes my phone. As long as I'm speaking, how can I help you? I'm sorry? Oh, hey, Stephen, how's it going? Yeah, you wanted that. You wanted the money to be withdrawn on the 20th, correct? Yeah. So I believe the first payment. I think when we send in the paperwork, we have it scheduled for the 20th, so that it should be coming out by then. Generally, the first payment they may take out within like a week. So once I submit it, generally. It might come out within the week, but we have it. I already told them that you want it scheduled for the 20th, so it's likely to be the 20th. Absolutely. So just to set your expectation, the first thing that's going to happen, and I'm glad that you let me know you signed because I didn't get the email yet. Once I submit everything, I'm going to email you a copy of your policy just so that you do have a digital. But I will also speak to the company and request that we mail you a physical copy. I don't know how long it takes for them to do that. But I generally I say give them like a week or two because they have to print it out and do all that, and they send that from home office. I don't actually physically send it. Uh, no, yeah, you have is this your cell phone? Do you want to? Can you do me a favor? You want to just text me the address so I have it exact? All right. Anything else I can help you with? Wonderful. And congratulations again, Mr. Moran. Take care. That was actually a client. So these are the types of things that happen as a financial professional, right? In the middle of your day, you get clients who sign paperwork, and you gotta obviously speak with them and help them there. But that's also part of the things like knowing your customer. So let's get back to it. So, where were we? So we were reading. So it is important to point out that fixed annuities do still have risk. The fixed income provided by fixed annuities can lose value to inflation. An annuity income may need to span several decades. With even modest amounts of inflation over that much time, a fixed income can turn from adequate to less than subsistence level. A variable annuity, however, provides a potential hedge against inflation. That, of course, depends on a trend of favorable investment performance, of which there can be no guarantee, but the potential is there if one is willing to accept the risk. So again, as you can see, this is here for me, but it says for registered representative training only. So this is why I get pissed off at people, because they're not registered reps. And they're coming in here talking like they're basketball gods or football gods or fitness gods, and they ain't never worked out a day in their life. Not saying that they may not know some of what they're doing, because just like my man Diamond Dave said, just because you have the license does not mean that you're a adept, but the license does add something. Okay, so when people buy a variable annuity as an investment, they're looking for many of the same things as those who invest in the stock market or in a mutual fund. They hope to receive a greater return on their funds than they could gain from any type of fixed investment. The return is not without risk. The owner of the variable annuity contract bears the risk if the variable annuity value decreases over time. Yep. Regulation of variable annuities as securities. Due to this additional risk, variable annuities and those who and those who sell them are subject to federal securities regulations as well as to state insurance regulations. Variable contracts must be registered with the SEC under the Securities Act of 1933, almost 100 years ago at this point. This means that generally the laws and rules that apply to securities also apply to variable annuities. For example, a prospectus, a detailed summary of the registration statement on file with the SEC, must be furnished in connection with any sales effort. So again, when people are telling you stuff like buy this stock, buy this crypto, buy this ETF, but they don't even mention anything about a white paper or a prospectus, it's very convoluted. Now and this is why the retail investor it loses a lot. There's protections, but you don't even know about the protections. Most people don't even know what a prospectus is to ask for it, right? That's like when I told a guy I said, hey, what do you do for a living? I'm a financial advisor. What is that? Insurance, retirement investments. What kind of insurance? Insurance, retirement investments. What kind of investments? Insurance, retirement, and investments. Just like if you go to Prudential. If you go to Prudential, what do they say? Insurance, retirement, investments. Edward Jones, insurance, retirement, investments. Morgan Stanley, insurance, retirement, investments. Exact same thing. So what happens, however, is you as the consumer are miseducated. So let's continue. So the company selling the variable contract must also register with the SEC as a broker-dealer under the Securities Exchange Act of 1934. This company may be a subsidiary of the life insurance company. Broker-dealers selling variable annuities must be members of FINRA, a self-regulatory organization to conduct business. Either the Series 6 investment company and variable contracts products representative registration, or Series 7 general securities representative registration satisfies the FINRA requirement. Sales representatives must comply with very strict FINRA regulations on all sales practices. Some states also require a separate state variable contracts or variable annuities license in addition to the life insurance license and FINRA regulation. The federal regulation of a life insurance company selling variable contracts is in addition to and not instead of the state insurance department's regulation of the company. Because of this, the company selling variable contracts is subject to dual regulation. So this is why you'll see me get pissed off at people like Wall Street Trapper. Because he ain't got to deal with two heads crushing on him. I got to deal with two heads crushing on me. Prime example, right? I do a lot of stuff on this here YouTube. You know, I had to take down about 5 videos because the company that I represent, even though I am my own boss, I work for myself. But some of the companies whose products I sell were like, we don't like what you said. And the state don't like what you said because you're educating people too much. So take it down. Or we won't let you give us money. I could bring them $1 billion and be like, nah, we don't want your $1 billion. And they make enough money to do that, to not take $1 billion from me. They probably would still take my $1 billion, but that's the reality. So Wall Street Trapper can run around and tell you whatever he wants because nobody cares what he says because he has no authority in this industry. That would be like me saying right now, I'm a better basketball player than Zion Williamson. Nobody cares what I have to say. I've never been on a basketball court. You see what I'm saying? Now, let's continue. All right, so there's a fixed test. Let's get this one wrong. So traditional fixed annuity contracts vary from variable contracts in that A, traditional fixed annuity contracts require the company to assume the investment risk, whereas variable contracts pass the investment risk to the owner. B, agents do not need to be licensed to sell variable contracts. C, fixed annuities allow multiple investment options. Or D, traditional fixed annuity contracts are designed to last for the lifetime of the insured, while variable contracts are designed for the shorter term. What do you think the answer is, ladies and gentlemen? A, B, C, or D? I know the answer. I want your question. I want to see who's paying attention. I want to see what y'all think. What's up, Queena? So again, what do y'all think the answer is? I know the answer. I'm going to come back and give y'all the answer, but I want to see what y'all think. So what do y'all think? Do you think it's A, B, C, or D? I'll tell y'all the answer is A. A traditional fixed annuity contract requires that the insurance company take the investment risk. So this is why you'll have a lot of insurance people who would prefer you, when you do your insurance, to do your insurance. And this is why you'll have a lot of investment people, even like my boy JT the Pocket Watcher, right? It's cliche terms. An apple a day keeps the doctor away, stuff like that. The answer, Wanda, is A. And the reason they say that is because, yes, with insurance, the insurance company takes the risk. Whereas with investments, the investor takes the risk. So let me ask you something, ladies and gentlemen. If I say, hey, give me some money and I want to bet that if this thing happens, if something goes wrong, your money's secure, I take all the risk. Or would you prefer something where you take all the risk? The answer is A, y'all. Just so you know. All right. So yeah. So the advantages of variable annuities. Okay. So the following are key benefits of variable annuities. Now, again, ladies and gents, I don't really talk about investments and stuff, but obviously, as you see here, this is my account from Kaplan Financial Education. So why would I be getting registered representative training? Probably because I am in that field. So the following are key benefits of variable annuities. There are no taxes on dividends or capital gains during the accumulation period, and the payments are taxed only to the extent that they exceed the owner's cost basis. This tax may be at a lower rate, assuming the annuitant is retired and in a lower tax bracket. A variable annuity may ensure a lifetime of income or a protection of principal. The variable annuity offers the ability to switch between funding options in the separate account without tax liability on the exchange. And a variable annuity avoids probate at death, assuming there is a named beneficiary. Now, just like everything has pros, things also have cons. So now let's look at the disadvantages of variable annuities. And the reason I also like to go through study this stuff, because I know a lot of people who work at banks, and banking and finance are two different things. Not to diminish, but what happens is a lot of people who work at banks, when you work at a bank, you become a glorified cashier, unless you're the registered rep or their private client banker. And even if they're private client banker, you only get sat with people for very specific things. You don't really need to learn the ins and outs. I have a buddy who works at Chase in Manhattan. He works at private client. I make him one transaction what he makes for the year. I made 2 sales last year, and I made more income than he did all year going to work 6 days a week in 2 sales. I made more than 2 sales, but 2 of those sales equated to about $60,000, which is his annual income. before bonuses and all that shit. Well, his annual income is about $89,000 base. But in 2 sales, I made basically $30,000 less than him. But there's nuances to this. As a independent registered rep, you do get paid well, but you have the risk of nobody knows or cares who you are. Nobody knows who the hell I am. Everybody knows who Chase Bank is. So now let's look at the disadvantages of variable annuities. The following are disadvantages of variable annuities. Variable annuities may be more expensive than other investment options because they include the expense of the living and or death benefits. This may lower the overall return. Due to surrender charges and penalties, annuity owners may not be able to switch easily from one insurance company to another in search of higher returns. Withdrawals are taxed at income tax rates rather than capital gains tax rates. And there is no step up in cost basis at death. So, separate account. Fixed insurance contracts are supported by the general assets of the insurance company. But because variable contracts represent a departure from the traditional guaranteed nature of fixed insurance contracts, the assets that support variable contracts are kept in a separate account, entirely segregated from the company's general assets. A separate account is an account maintained by insurance companies that is separate from the company's general account for the purpose of holding and managing variable contract funds. Within this separate account are a variety of sub-accounts that offer different investment objectives. The gains and losses passed through to variable contract owners represent only the investment experience of the separate account and not any part of the company's general assets. Furthermore, separate account assets are in no way affected by the liabilities of the company's other business. Separate account assets are owned by the insurance company and carried on its books, but are used only to support the company's variable contracts. Registration. In practice, a separate account operates like a mutual fund established by an insurance company to fund its variable contracts. This means that separate accounts must generally abide by the Investment Company Act of 1940, which was originally intended to govern mutual funds. In some cases, the SEC has granted exceptions to the law to account for the differences between mutual funds and variable contracts. Professional management. Like a mutual fund, the sub-accounts are handled by professional investment managers. Certain prohibitions concerning statements about professional management apply, as they do to mutual funds. Professional management has its advantages, but it is not a guarantee of success. Even full-time managers who are well-versed in the investment industry don't always pick winners, and they can't control unfavorable economic or market trends. Producers are forbidden to say or imply that professional management guarantees a gain or guarantees against loss, or to make extravagant or otherwise misleading claims about management ability. Which is why it's very dangerous that people like Larry Jones and Stock Mo and Stock Up With Me and I Do Stocks and Mommy Stocks and all these social media influencers who don't have any of these credentials. You may want to take some of what they say with a grain of salt. Right? It's just like a lot of these health channels that come up. Am I saying the information is wrong? No. What I'm saying is you still want to check it against a verified professional. A lot of what they say may be true. So now let's look at diversification. Sub-accounts seek diversification for the same purpose as a mutual fund. By owning the securities of many companies, the risk of investing is spread out amongst those companies and reduced. A drop in the value of one security will be cushioned by the gains of the rest of the portfolio. Had to pour my lemon water. While the investment objectives and managers of subaccounts are similar to mutual funds, subaccounts and separate pools of assets and the underlying securities and performance will vary. Be sure to explain to your clients that the performance reported for mutual funds and their ticker symbols will not be representative of the performance of subaccounts. Subaccounts typically do not have ticker symbols. Investment policies of sub-accounts. Like a mutual fund, the management of a sub-account is guided by an investment policy, which must be stated in detail in the prospectus. The investment policy should be matched to the investment objective of the contract owner. Investment policies vary among sub-accounts and include many of the same categories as mutual funds. As we'll see next, sub-accounts may be classified by objective or by type of underlying investment. Asset allocation. Virtually all companies that sell variable contracts have a number of different sub-accounts or portfolios into which contract funds may be allocated. Contract owners are not restricted to putting all their funds into just one portfolio. Contract owners are generally given a high degree of flexibility in allocating their funds and in changing their fund allocations. With this flexibility, contract owners may, if they wish, be their own investment managers. Asset allocation is a process of determining and maintaining a mix of investments that best suit a client's investor profile. An investor profile is determined by analyzing the client's investment goals and objectives, investment time horizon, and risk tolerance. A couple words that I never hear any of these stock channels talk about is time horizon, risk tolerance, time horizon, risk tolerance, time horizon, risk tolerance, time horizon, risk tolerance. Why do they never talk about your time horizon or your risk tolerance? Well, that's because they don't know about time horizon or risk tolerance. So before I go there, let's do this. Let's pull up Google. And let's do this entire screen thing again. Just so you guys know. What is a time horizon or risk tolerance? Understanding your time horizon is one of the critical factors that determines how you invest your money in the first place. The more time that passes before you need to convert investment asset to cash, the more volatility and risk you can tolerate. So people are telling you to get into this investment stuff and they're not telling you about your time horizon or your risk tolerance. So if you need to, if you're going into the stock market and you're like, and you don't have a time horizon, you're just like, I'm gonna put this money in here and it's gonna go up. That's why you should not be investing. That would be like saying, I'm going to turn on the oven to 400 degrees and I'm going to put a cake in the oven. And I'm just gonna sit it there. I don't know how long I'm gonna sit it there for. And every 5 minutes, I'm gonna check on it until it's done. Or every 2 seconds, I'm going to check on it until it's done. Because I don't know how long you're supposed to sit a cake in the oven before it's done at 400 degrees. Well, you wouldn't eat that person's cake. You'd be like, every time you check it, it's never going to bake because you keep opening the oven, releasing the heat. So you're not going to get an even cook. So your investment portfolio will never be an investment portfolio. What is an example of a time horizon? So time horizons are largely dictated by investment goals and strategies. For example, saving a down payment for a house for maybe 2 years would be considered a short-term time horizon. So again, 2 years or less is short-term. While saving for college would be a medium time horizon, and investing for retirement would be a long-term time horizon. So those are just a couple of things I wanted y'all to look at was time horizons. Okay, so asset rebalancing. Asset rebalancing is a technique. Let me stop that. Hold on, because I got to learn how to read here, apparently. Asset rebalancing is a technique used by professional portfolio managers to help reduce risk and improve a portfolio's overall return. It involves making securities trades at certain intervals to bring the asset mix back in line with the allocations originally determined for the portfolio. Common if one asset category outperforms another, or to establish a new allocation model, perhaps upon entering a new stage in the life cycle. In effect, the portions of the portfolio that have performed the best are reduced so that additional assets can be invested in the portfolios in the portions of the portfolio that have performed the worst. Asset rebalancing follows the old age investing adage: buy low, sell high. Because different categories of investments tend to go through cycles of lows and highs, periodic asset rebalancing may improve the portfolio's return over the long term. Active management by variable annuity owners of their asset allocation model is one way that they can control their investment portfolio and keep it from creeping far beyond their personal risk tolerance levels. So, ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. Woo! Lemon water. What I did last night, I cut up some lemons, and I got this here water bottle. So I cut up some lemons, put them on the bottom, dropped a bunch of cold ice on it, put some more lemons, dropped more cold ice, put the third layer of lemons, more cold ice, and then the fourth layer of lemons. Just sliced them up real thin. Just one whole lemon. And then I filled the bottle with water, and I just let it stay overnight. Now, if I put some honey or something in that, that's straight lemonade. And black men challenge the black men. We eating healthy. We living life these years. So, variable annuity sub-account transfers. Maintaining a particular asset allocation requires that the portfolio be regularly rebalanced through the buying and selling of assets. While portfolio rebalancing may result in sizable transaction costs and possible incoming capital gains taxation, when dealing with, give me 1 second here. What's going on, brother?
Yeah, Betsy Oliver today.
Okay.
So
that's no problem.
Yeah,
we could do a phone call.
Yeah, I told her.
You want to do that today?
Yeah, she said 8 o'clock tonight.
That's 9 p.m. my time. She gonna have to be guaranteed to, huh?
Yeah, that's what I know. That's what she said. So yeah. I just have to. I'm gonna check back with her about. I check back with her about 7 o'clock, whatever. See, yeah. 8 o'clock. Check back with her.
And what is it she wanted again?
She want regular insurance.
Okay, cool. Insurance. Yeah, we'll knock that out tonight. I gotta get with you. I'm on live right now, but I gotta get with you because there's a piece missing from your delivery. So there's a piece that says the summary.
Yeah, I understand what that is.
Yeah, I'll show you that. Okay. And we'll get that done. I gotta get ready for Wednesday. You know, Wednesday I'm going to we having another dinner, Fogo de Chao. I'm making the company too much money, so they decided. Yeah, I'm making them too much money, so they done took me out to a nice little steak restaurant out here in Connecticut. So they said, all right, you done made us a couple more dollars. We gonna take you out today. They taking me to what is it? The one that lead attorney talk about all the time, Fogo de Chao.
Okay.
So we going to that one Wednesday, and I got the heads from the company coming down. So me and Charles gonna be up there schmoozing them, you know, them Nebraska white folks.
Oh, okay.
Yeah.
Yeah. So yeah. So I said, let me call them up right quick. But I know, you know, I'm going back on them leads, man. Like you told me, bleed them dry, man.
Mm-hmm.
Bleed them dry. So, like you said, somebody gonna eventually, trying to submit policy around this motherfucker.
Yeah.
We don't submit policy around this motherfucker. Get some money.
Exactly. But you're doing the exact perfect thing, man. You just got to bleed them dry.
So you on live right now? You on the internet?
Yeah, I'm doing some continuing education on my YouTube.
All right, come on over there, man.
No doubt. I'll see you in here.
All right.
All right. Okay. So, yeah, lemon water is the bomb cleaner. The bomb. So, while portfolio rebalancing may result in because asset allocation rebalancing inside a variable annuity contract is not deemed to be a sale and purchase of an asset, it does not result in a tax liability. Furthermore, the commissions that the investor must normally pay to buy or sell stocks and bonds, the commissions that the investor must pay, because they always want to talk about those fees. They never, oh yeah, we traded no commission. You're always going to pay a commission. Even in those zero commission QQQ Fidelity, trust me, you're paying a commission. You might not see it, but there's a commission being paid. Furthermore, the commissions that the investor must normally pay to buy or sell stocks and bonds or to purchase load funds, ETFs, do not apply to a transfer of funds from one variable annuity subaccount to another. So that's the only way you're going to beat that. Variable annuity subaccount transfers are subject to certain limitations, however. Depending on the company and the contract, transfers between subaccounts might be limited as follows. A certain period of time may be required between permitted subaccount transfers. The number of subaccount transfers permitted annually may be limited, and the number of subaccount transfers permitted each year may be unlimited, but a fee may be charged for transfers that exceed a specific annual limit. In addition, transfers from the fixed account are limited to a certain percentage each year because long-term assets normally used to guarantee the principal and interest in the fixed account might otherwise need to be liquidated at a loss. Insurer involvement asset allocation. Prince Pierre, what's going on? Some insurers facilitate asset allocation by offering an asset allocation subaccount in which a money manager modifies the investment mix to attempt to achieve the most favorable return. Although this approach is simple and easy for prospective annuity contract owners to understand, an asset allocation subaccount is unlikely to match the specific objectives or risk tolerance of very many contract owners. A somewhat similar approach is offered by other insurers whose money manager is authorized by the contract owner to make transfers between the variable annuity subaccounts based on the manager's assessment of the outlook for each of the asset classes. Many insurers offer this automatic asset rebalancing service, generally free of charge to their variable annuity contract owners. Without automatic asset rebalancing, the owner establishes target percentages for various investment options, and the insurance company periodically makes transfers between the owner's subaccounts to bring the investment mix back in line with the owner's objectives. Of course, there are no guarantees that automatic asset rebalancing will improve an owner's return, nor does automatic asset rebalancing provide any assurance against the possible poor performance of the securities underlying the investment. Why is it, though, that people keep saying keep insurance, and investment, but everything here from the training manuals, from the Financial Industry Regulatory Authority, from the Securities Exchange Commission keeps saying insurance, investment, insurance is investment. Well, that's odd. Oh, you know what? Before I do that, well, you know what? I'm going to continue that, but I'm going to pull up the article too. So, some insurers facilitate asset allocation by offering an asset allocation subaccount. I read this already. I'm sorry. Variable annuity charges and fees. Because variable annuities are more complex and cost more to administer, variable annuities are liable to have higher costs and impose more kinds of charges than fixed annuities. Not all variable annuities assess every possible kind of charge, but some do. All sales charges and expenses are detailed in the prospectus. Surrender charges. Most variable annuities do not assess a sales charge immediately. This allows the owner to start earning on 100% of the money invested right from the start. Account balances may grow faster when they are not immediately reduced by a commission. But, give me 1 second, my house phone's ringing. But companies may still pay commissions to producers immediately when the contract is sold. To offset this cost, companies charge a surrender fee. Most companies impose a surrender fee only if money is withdrawn from the contract by either full or partial surrender within a certain number of years. This is called a contingent deferred sales charge. This charge is assessed against the amount of money withdrawn from the contract. For example, if the contract has been enforced for more than 7 years, no sales charge are assessed. In many cases, the contingent deferred sales charge is scaled down over a period of years. 7% for contracts surrendered in the first year, 6% for contracts surrendered in the second year, and so on. This recognizes how the company progressively recoups its sale costs and the longer a contract stays in force, just as with fixed annuities. Some companies base the surrender charge on the premium deposit. Other companies base it on the total surrender value of the account. Withdrawals also may be subject to ordinary income tax consequences on any taxable gains and a possible 10% penalty on early withdrawals made before 59 and a half. Policy maintenance fee. Many companies assess a maintenance fee to pay for the expenses of maintaining the contract on their books. This is often a flat dollar amount that is assessed once each year. This generally ranges from $30 to $60 annually and is generally waived once contract values exceed a certain amount, such as $50,000. Not all variable annuities have a policy maintenance fee. Administration charge. Some variable annuities also have an administration charge based on percentage of the daily net value of the separate account as a whole or of each subaccount. Though computed on and deducted from the net value of the separate account as it changes each day, this charge is usually expressed on an annual basis and typically ranges from 0.05 to 0.4% depending on the company. This charge may be deducted in addition to the flat annual fee or quarterly maintenance fee. Not all variable annuities have this type of fee. I think after this, I'll probably close out because I got a couple of things to do today. Mortality and expense charges. All variable annuities deduct charges for mortality and expense risks. Like the administration charge, M&E charges are computed and deducted from the net value of the separate account each day, but are usually expressed on an annual percentage. The M&E charge is usually shown as a combined charge, though many companies also show the breakdown into the mortality and expense elements. The combined percentages vary widely, ranging from about 0.5% for some companies to over 2% for others. The company's mortality risks come from two sources. The primary source of mortality risk is the death benefit that the company guarantees to the beneficiary in the event of the owner's death before the annuity starting date. It is generally possible for the death benefit guaranteed by the company to be greater than the value of the separate account at the time of the owner's death. The mortality risk compensates the company for taking on this risk. The other source is the cost of providing a guarantee associated with potential annuitization of the contract. The payment amounts are based on mortality statistics, but there is a chance that the annuitant as a whole will live longer than statistics indicate, making those lifetime guarantees more expensive to the company. The source of expense risk is that it may cost more to administer and distribute the contracts than the company anticipated. The company guarantees that its mortality and expense risk charges will not increase. It should be a unit test. And not a unit test? What's going on here? Investment management fee. In addition to sales administration charges, there are various other charges that are identified in the prospectus. Each subaccount has an investment management fee, which pays for the professional investment management of the subaccount. This fee is a percentage of the average daily net assets of the subaccount. Fund expenses vary by type of fund, but some funds tend to have consistently lower operating expenses. Expenses for simpler funds, such as money market funds or stock index funds, may range from about 0.3 to 0.6% annually, while expenses for more complex growth stock funds may range from around 0.7 to 2% annually in some years. So never, ever let anybody tell you that there's these zero fee, zero commission trades, because it's not possible. Hey, Cyrax. So I am doing some continuing education about knowing your customer, insurance, and investments. So, characteristics of variable annuities. So, types and payment options. Variable annuities may be immediate or deferred, single premium or flexible premium, or have single or joint life payouts. Variable annuities may even have a fixed account into which annuity owners may direct their premium deposits. As a remainder, the cash value accumulation varies with investment performance in the market. Therefore, the payout on a variable annuity will also vary. Excuse me. Therefore, the payout on a variable annuity will also vary based on the sub-account investment performance in the market. To help manage this risk to contract owners, most insurance companies offer an array of living benefit riders. We will start by comparing annuitization with systemic withdrawals in the next section. Systemic withdrawals is actually something that I have going on with my buddy Marty McFly. Anybody who watches this, he and I are doing stuff like that. This is cool. Something I know nothing about and definitely need to learn. Yeah, insurance, retirement, investments, Irats. I am a financial advisor. That's what I do for a living. That's why you see me and Simon, you know, even though we're both weird, kindred spirits as far as, you know, black guys who are professionals, and feeling kind of how we feel about our communities. But everybody feels some type of way about their own community, as I'm learning. Systematic withdrawals. One long-standing criticism of the annuity focuses on the very feature that others hold up as its primary benefit, the lifetime income guarantee. More specifically, critics argue that the irrevocability of the annuitant's decision to annuitize, a commitment most insurers require in return for their guarantee to pay benefits for the annuitant's lifetime, locks consumers into a financial contract they may one day prove unsuitable. Certainly, consumers must understand that the long-term nature of annuities before purchasing either a deferred or immediate annuity. Those who realize their decision to purchase an immediate annuity or annuitize a deferred annuity is a permanent one usually consider this a fair price to pay for the assurance of an income that cannot be outlived And of course, the purchase of a variable annuity strengthens the benefits of a lifetime income with the opportunity to keep pace with inflation. Consumers who remain unsure of the merits of annuitization have an alternate means of receiving annuity benefits, though it does not include the insurer's guarantee of a lifetime income. This alternative is referred to as the systematic withdrawal method, and this option is offered as an alternative to annuitization by most insurance companies. The systemic withdrawal process is quite simple. Each month, the insurer withdraws and sends to the contract owner an amount the contract owner specifies. In most cases, the annuity contract permits the withdrawals to be made at no charge. One of the main advantages of this distribution methods is its flexibility. Contract owners may suspend and resume payments at virtually their own discretion. Consumers who are uncertain about their future income needs usually find this to be an appealing alternative to annuitization. There are drawbacks to the systemic withdrawal method, perhaps the most significant being the loss of the exclusion ratio. That is, systemic withdrawals are taxed on the same basis as any withdrawal from a deferred annuity, as a distribution of earnings, LIFO, last in, first out rule. Only after all earnings are withdrawn will the principal ever be distributed. Guaranteed living benefit riders. Most variable annuities sold today include the options of living benefit riders. Unlike fixed annuities, variable annuities do not guarantee a rate of return or the safety of principal. Because some consumers are reluctant to invest in products that do not provide guarantees, insurance companies have introduced a variety of guaranteed living benefit riders that may be purchased with annuities. These living benefit riders can provide withdrawal, income, or accumulation guarantees. In effect, these riders guarantee minimum growth rate applied to a benefit base and enhance the appeal of variable annuities by protecting contract owners against poor investment performance in their sub-accounts. They're usually issued as optional riders, requiring the contract owner to pay additional fees. The most common guaranteed living benefit riders include the following: GLWB, GMWB, GMIB, and GMAB. Guaranteed lifetime withdrawal, guaranteed minimum withdrawal, guaranteed minimum income, and guaranteed minimum accumulation benefits. A tale of two balances. Understanding how a variable annuity with a living benefit works requires you to understand the actual makeup of this kind of annuity. The fundamental feature of a variable annuity with a living benefit is that it has two distinct balances operating simultaneously: the contract value and the benefit base or protected minimum amount. The contract value, which is also known as the account value, account balance, or cash value, represents the amount of money derived from the contract owner's investments or sub-accounts within the annuity. This dollar amount is the amount of money that contract owners can access at any given time during the term of the contract, less any applicable surrender charges. A contract owner who decides to cash out of a variable annuity with living benefit can take a lump sum distribution of the contract value. The benefit base, or protected minimum amount, which functions at the same time as the contract value, represents the amount of money used to calculate the guaranteed income that the contract owners can withdraw from the annuity each year. As discussed previously, the benefit amount is typically expressed as an annual percentage of the benefit base. Unlike the contract value, the benefit base cannot be withdrawn by the contract owner when needed, operating more like a hypothetical balance. The benefit base is not a cash value that contract owners can take out of the annuity. Clients also cannot take a lump sum distribution of the benefit base. Rather, the benefit base is used only to figure the guaranteed income that can be taken out of the annuity each year. If a contract owner of a variable annuity with a living benefit wants to cash out of his annuity, which has a $150,000 contract value and a $200,000 benefit base, the owner could take out only the $150,000 minus any surrender charges. The irony of this scenario is that the contract owner would not benefit from the living benefit rider, given the fact that the owner decided to withdraw the contract's account value and not take advantage of the living benefit rider's benefit base. The fundamental distinction between a variable annuity's contract value and its benefit base is that the guarantees on the living benefits and death benefits, such as a roll-up, step-up, and guaranteed income, are determined based on the benefit base, not the contract value. A variable annuity without a living benefit rider has no benefit base and provides the owner no guarantees in terms of principal or returns. The contract owner of such an annuity depends solely on the annuity's contract value, which provides no guarantees in how the annuity's investment will perform in the market. GLWB. The Guaranteed Lifetime Withdrawal Benefit is an optional rider that guaranteeing that the owner of the variable annuity can make certain systematic withdrawals for life and be assured of receiving a guaranteed amount of income, regardless of the annuity's contract investment performance. Under a GLWB rider, the owner can withdraw up to a specific percentage of protected value called the benefit base each year for life, even if the contract value, also known as the account value, account balance, or cash value, drops to zero and the total withdrawals exceed the benefit base. There are two basic components of a GLWB: the benefit base and the benefit amount. The benefit base under GLWB is the dollar amount that is guaranteed to be available to the owner through systematic withdrawals. When the contract is issued, the benefit base is generally equal to the owner's initial deposit. Under some contracts, the benefit base is increased. If the owner makes subsequent investments, some GLWBs provide that the benefit base will increase by the amount of any additional purchase payments made during the term of the rider. Others may increase the benefit base for premium payments made during a certain period, such as the first 2 years of the contract. The benefit amount under GLWB is the maximum amount the owner is allowed to withdraw from the contract during any year under the rider. The benefit amount is generally expressed as a percentage of the benefit base at the time the owner begins withdrawals. A common GLWB withdrawal percentage is 5 to 6% annually. For example, if the benefit amount were 5% and the benefit base were $100,000 at the time the contract owner begins making withdrawals, the owner can make systematic withdrawals of up to $5,000 each year for life under the rider. The contract owner can decide to take monthly, quarterly, or annual withdrawals depending on the contract's term, but the withdrawal amount will always be based on the annual benefit amount calculated under the rider. For instance, if the contract owner in the earlier example wanted to make monthly withdrawals, the owner will receive $416.67 in monthly withdrawals from the variable annuity, or $5,000 benefits divided by 12. GLWB2. A common misconception is that the GLWB is a guaranteed minimum withdrawal benefit. Although the two riders are similar, there is one key difference. The GMWB rider guarantees that the contract owner can withdraw up to a certain percentage of the benefit base each year, even if the contract value drops to zero, but only until total withdrawals equal or have exhausted the benefit base. In contrast, the GLWB, or the Guaranteed Lifetime Withdrawal Benefit Rider, promises that the contract owner can receive such payments each year for life, even if the contract value drops to zero and total withdrawals exceed the benefit base. Suppose your client Cassie, age 50, invests $300,000 into a variable annuity with a 5% GLWB rider. The rider states that the benefit base will increase at 7% each year, known as a roll-up, which is discussed later in this lesson. Although a GLWB commonly does not require a waiting period before an owner can begin withdrawals, a roll-up generally ends at the first withdrawal or the end of a certain period, typically 10 years, whichever is later. This provision was included in Cassie's GLWB rider. Cassie decides to start making withdrawals when she turns age 60 in year 10, the year in which the roll-up stops and the benefit base is locked in. In year 10, the benefit base is $590,146. And let's assume that the account value is $322,250. With the GLWB rider, Cassie can receive a lifetime withdrawals of up to 5% of the benefit base. Cassie's benefit base is $590,146, which gives her a withdrawal guarantee of up to $29,507 annually for the rest of her life. It is important to note that if Cassie were to make withdrawals that exceed the 5% amount, it could negatively impact her guaranteed withdrawal amount. Additionally, if Cassie's contract has positive performance, it may increase her guaranteed withdrawal amount. A GLWB guarantees that you will never outlive your assets. That makes this rider suitable for investors who plan on a lengthy retirement and who desire the comfort of their regular guaranteed income for life. GMWB, guaranteed minimum withdrawal benefit. So while the GLWB riders are far more common in today's marketplace, their predecessor, the GMWB, or guaranteed minimum withdrawal benefit, may also be available. The key difference between the GMWB and the GLWB is that the GMWB is not guaranteed for the life of the contract owner. So the owner can make systematic withdrawals over a specified period and can be assured of receiving at least a return of premium or the benefit base, regardless of the annuity contract's investment performance. The attractive feature of the GMWB is the variable annuity contract owner's recovery over time of no less than the benefit base, regardless of market performance, and even if the account balance drops to zero. The owner usually has the right to stop and restart the systematic withdrawals under GMWB at any time, but withdrawals are generally not cumulative from one year to the next. So if the maximum annual withdrawal amount under a GMWB is $10,000 and the owner only withdraws $8,000 one year, the maximum withdrawal for the next year will be $10,000, not $12,000. The owner is still assured of being able to make withdrawals until the benefit base is exhausted. For example, an investor purchases a $100,000 variable annuity with a GMWB of 7%. Even if the market value of the annuity contract has fallen to $50,000, the GMWB guarantees that $7,000 or 7% of the $100,000 can be withdrawn each year until the entire $100,000 has been paid out. The GMWB rider does not require annuitization and may limit the type and range of investments that a contract owner can select. Typically, GMWB riders do not impose a waiting period before the contract owner can start making withdrawals. I'm surprised there's still no unit test. GMIB, guaranteed minimum income benefit. When a contract owner purchases a variable annuity with a GMIB, the insurance company guarantees that the owner can eventually annuitize a certain minimum guaranteed income base, regardless of how poorly the owner's investment sub-accounts perform. You know, this is funny because this is about the people who have the investment licenses, and all the people online, all they talk about is investments going up. While as the people who, this stuff, as you see here, right on the bottom of the screen, it says for registered representative training only, right? It's timestamp Monday, April 8, 10:15 a.m. Central Standard Time or 11:15 a.m. Eastern Time from Kaplan, because this is real time. Ask any of your Wall Street trapper or any of them bullshit motherfuckers I talk about to do this in real time. They cannot. They will not, because they cannot. So the following are different methods of calculating the guaranteed minimum income base. Roll-up method. The annuity's benefit base is increased by a certain percentage each year for a specified number of years. Increases may be compounded annually. For example, a GMIB rider might provide that the owner's contribution will be increased by 5% annually through age 85. Step-up method. The annuity's benefit base is equal to the highest adjusted contract value on a certain specified contract anniversary dates during the term of the guarantee. These step-ups typically occur on an annual basis, with an annual step-up. For example, if the highest contract value occurred on the 7th contract anniversary date, that value would be locked in as the guaranteed minimum income base, even if the contract value declines steadily in later years. Greater of method. Some annuities offer both the roll-up and step-up methods. In this case, the annuity's benefit base would be equal to the greater of these two values. GMIB2. For example, Sam, age 45, invests $300,000 into an variable annuity and purchases an optional GMIB rider that provides an annual roll-up of 5% until 85. Sam decides to begin receiving income benefits from the annuity when he turns 65. Because of poor performance by Sam's sub-account investments, the contract value of the annuity when Sam turns 65 is only around $350,000. Under the GMIB rider, however, Sam's guaranteed minimum income base is roughly $796,000. Therefore, Sam can annuitize $796,000 instead of the lower contract value of $350,000. The guaranteed minimum income benefit rider guarantees a minimum level of annuity payments by the insurance company, regardless of the contract's separate account performance. This rider can be useful for more conservative investors, although it comes at a cost. We can further demonstrate how this works through this following example. The amount of $100,000 is invested in a variable annuity that has a GMIB rider guaranteeing the greater of the actual value. 5% interest compounded annually, or the highest contract anniversary value of the annuity. 10 years later, a sluggish market results in the annuity being worth $130,000. The contract owner has the option of taking this total as a lump sum and, under ordinary circumstances, annuitizing on the basis of that amount. However, with the GMIB, the owner has the option of annuitizing $162,965, $100,000 compounded at 5% annually for 10 years. Had the value of the annuity zigzagged and at one point during those 10 years been worth $200,000, then the contract owner could have elected the third option, i.e., the highest contract anniversary value of the annuity. And then after this, I got hey, no doubt, Prince Pierre. Listen, you know I'm gonna drop that game because it's people like us who out here really getting certified and stuff. Because if y'all don't know, shout out to Prince Pierre, game show host in the building. Oh, Zyrax, hold on, I don't have you with it. Let me go on YouTube. I don't have you with a wrench. But it's people like me and Prince Pierre who we out here, we really do this, right? We do this for a living, right? And Prince Pierre will tell you right off the rip, he's along with me, and he's getting his study on because he is just like me. He's like, yo, I can't deal with these non-certified individuals. If I want to deal with something, I want to deal with it when it's the real deal, the certified, whoever's actually doing it and teaching it. That's what I want. I don't want to deal with these non individuals. Give me 1 second. My phone just rang. See who this is.
A representative will be available shortly to take your call. If you did not receive a letter or you think this call is an error, please press 2 to speak with a live manager and to be put on our do not call list. If you owe over $5,000 in back taxes, please wait on the line.
Oh,
a representative will be available shortly.
All these spam calls. Hey, even as a salesperson, you got to deal with sales calls. That's part of what we do for a living. So GMIB riders impose. Oh, give me 1 second here. Vincente, good morning. How are you?
All right.
All right. Congratulations. I spoke to Mr. Moran.
All right.
He signed everything. I've got the address to have them deliver by mail his policy. And then we have set up for him the payments. So everything other than that is perfect. And we're good to go there. Congratulations.
Thank you very much. I would like in the future with any case, if we can come, well, I'm not calling, but I would like to see the company can mail the, every time they can mail to us. I will check with Carlos and I'll call him back because you know why? I want to do this too with the other company because that way I try to make sure everything is in order, get referrals, follow up as an agent. What do you think?
You've been in this business a long time, haven't you, Vincente? You're doing this old school, man. I remember policy deliveries and when you physically delivered policies. I'll tell you, you can ask when we submit the application that they deliver you a copy. Generally, a lot of things, because we've been doing e-sign since the pandemic, most companies are switching to a digital copy. You can, one thing you can do, now this may be something you'll probably have to absorb the cost yourself, but you can always, because they do a digital copy, you can actually physically like go to Staples and print it out on real nice paper for the client and deliver it yourself that way. But you can also ask the company, because what the company will not mail you a copy, they'll mail it to the customer.
Okay, so what they can do, what you're trying to tell me that the company can email it to me too, like a copy for me and a copy for the client, right?
Yeah, so that's how normally they deliver, is they email you a copy to deliver to the client. When they email it to you, you can physically print it and deliver it to the client.
Oh, all right.
Okay?
Okay, so it is because you're right on that. You save you, and maybe they might charge you a lot of money for a hard copy. There's gonna be a lot of pages, right?
Mm-hmm.
Right, makes sense. Unless the client wants to do it himself.
Yeah. Well, like I know Mr. Moran, I'm gonna have them mail him a copy. The company does not mind mailing copies, but they're not gonna do that for every single client, and they're not gonna physically mail us, the agent, the copy. Especially at our agency, you got to realize, especially on my team, I'm licensed in 13 states, so there would be no way for me to physically deliver any of my most of my policies. I have clients in Colorado. I'm physically in Connecticut.
Right.
You know what I mean? So that would be very hard for me to drive to Wisconsin and deliver a policy.
Yeah, you're right. Makes sense.
Are you coming to the dinner on Wednesday?
What time?
I believe it's 5:30.
5:30 in the evening.
Yeah, we're going to Fogo de Chao. We're in Long Island though. It's not in the city.
Oh my God! Wednesday is my tax office day. It's my tax office because I put in with the Liberty Wednesday and Saturday. Unless you make I will try to see if I can see Wednesday. But they want me to finish off because this is the last week.
Yeah, last week of tax season. Tax day is my birthday, April 18th.
Thursday?
Yeah, April 18th is is tax day, where the final day. It used to be April 15th, but they pushed it to April 18th. Right. And April 18th is my birthday, so now my birthday is tax day every year.
Oh,
yeah.
Right. Wow. Okay, so what I'm gonna do is then for the Wednesday, but the thing is.
Well, if you didn't respond already, because this is from the company, so if you haven't responded, then there is probably already booked up.
Okay.
Yeah, so don't worry about it. There will be a lot more dinners, and you working with me, you're gonna be in the next award ceremony if I have anything to say about it. Okay.
Okay. Thank you, Alonso.
No problem.
So what I just wanted to see if you can
Well, you tell me that you have. What is your next meeting on the workbench? Next class on the workbench?
So I haven't. I have Charles just got back from vacation, and I haven't. We haven't worked out a full schedule for the training, because obviously, you know, I still have to do my production, but I also do have my team, and the difficulty right now is that with my team that we don't have solid schedules, but yeah.
You know what I wanted to do? I'm sorry to call you. I just wanted to write down each step, but on a very simple case, like because if you tell me, well, hit here, right? When I say we doing it, right? And then you tell me hit here, and then when I'm going to the second step or third step or even fourth step, I know there's a lot of steps. But when you explain it on the first one, then I forget about the second one, or I forget about the first one. But if you tell me, look, hit this, and I write it down, hit next, and I write it down, hit this until we go all the way to the person's sign. I use that as
a template. Okay.
Yeah, it's very easy for me because I know that you have to explain me each step, like when you're doing the training.
Right.
You have to explain everybody what this means. But when people explain to me about steps and processes, I lose track right away when I get too much explanation. It's not that I need too much, but I know that I function better when I have a template, even as a very simple case. But then from there, I will learn if I have a difficult case because I have a template already to submit one.
Right.
So if I don't know if you can have some time during the day that because I know that would take me like maybe 5 minutes, right?
Well,
hit this, I write it down. Hit this, and then.
Well, the difficulty is with that. We'll probably have to do it with an actual case. And the reason that it's almost not that simple is because it's a case by case scenario. So, for example, depending on the type of case we're applying for, if it's simplified underwriting or if it's a fully underwritten, so you might be going through a process where you're written down, hit this, hit this, hit this, and then you run into something like they don't qualify for accelerated underwriting, and you won't know where to pivot from. So don't worry though. I intend on doing more trainings. Okay. And do me a favor. I think I don't know that we don't have a training tomorrow. So Wednesday, can you remind me and Charles? Just keep reminding me and Charles, and more or less me, because I want to put you and Carlos and a couple of you guys from Combined, and I have guys on my team that I want all working together. Okay. All right? All right. Talk to you later, brother.
Thank you, also.
Bye-bye.
All right.
That is called bullshit right there. But I prefer to be a leader. I like to lead by only doing things and only asking people to do things that I am willing to do or have done, right? Prince, I'm sure you're familiar of that as well, right? So where were we now? All right, so next page. So GMAB, guaranteed minimum accumulation benefit. So many people nearing retirement are more conservative about investing in equity markets because they are concerned about potential loss of value. But they also realize that equity and bond markets have the potential to generate returns greater than inflation. The guaranteed minimum accumulation benefit rider addresses the fear that when it comes time to withdraw or annuitize the contract, the value will be less than the original premium invested. While GMIBs and GLWBs are primarily focused for ensuring income, GMABs ensure the asset and should not be used if the client's goal is income now or in the near future. A guaranteed minimum account benefit is a living benefit rider guaranteeing that the owner of a variable annuity will receive at least a return of principal in a lump sum after a specified waiting period. A GMAB typically provides that if the actual contract value at the end of the waiting period is less than a guaranteed minimum value, the insurer will make a one-time contribution sufficient to bring the contract up to guaranteed value. The guaranteed minimum value is generally defined as equal to 100% of the owner's initial premiums. GMAB. For example, Jasma purchases a variable annuity that has a GMAB rider with a 10-year waiting period. Her initial premium is $100,000. After 10 years, due to poor market performance, the annuity is worth only $87,000. However, because the GMAB guarantees that the contract value will be restored to 100% of Jasma's initial premium at the end of the waiting period, the insurer will make a one-time contribution of $13,000 to restore the contract to its guaranteed value of $100,000. If, on the other hand, Jasmine's annuity is worth more than $100,000 at the end of the waiting period, let's say $133,000, Jasma would not need to use the GMAB benefit she purchased. When a GMAB rider terminates after the waiting period, the owner can then choose to continue the contract as is, annuitize, or select a systemic or lump sum withdrawal. Until the 10-year contract anniversary, the guaranteed accumulation amount does not guarantee a cash balance and is not available as a lump sum withdrawal. Therefore, the surrender of the annuity before the GMAB maturity date could result in a loss to the investor to the extent that the surrender charges apply. No benefit has been received from the fees paid for the rider, and or the contract has lost value to the market conditions and fund performance. Should be a unit test. Let's see. No? What's going on here, computer? No, guess not. Key features of GMAB. Many GMABs also provide 100% protection for additional premium payments made during the first or second year of the contract, and some provide a declining level of protection for premium payments made later. The waiting period in a GMAB rider is often 10 years, although other periods may be available. The guaranteed value under a GMAB rider will be reduced if the owner makes any withdrawals during the waiting period. One key difference between GMAB and a GMIB is that a GMAB generally does not require the owner to annuitize the contract to exercise the rider. The owner of a variable annuity with a GMAB can still annuitize the guaranteed minimum account value at the benefit date if she chooses, but the owner can also withdraw the guaranteed minimum account value in a lump sum, take systemic withdrawals, or leave the money in the contract. This additional flexibility appeals to many investors who do not want to completely annuitize their contracts and possibly limit their financial options in an emergency. Wow, it's a long unit. Fees on variable annuities with living benefits. And ladies and gentlemen, if y'all got questions, make sure y'all type them in here. I'm trying to get to a unit test and see if I can recruit me some more recruits like Mr. Pierre here, who's one of my all-star rock stars, and Mr. Williams, who you just heard me on the phone with, who's another one of my all-star rock stars, who have now joined the team of the All-Star Advisory, or ADH Wealth Solutions. A suitable sale of an annuity requires insurers and producers to adequately disclose all associated costs of the annuity. An insurer and producer's duty to fully disclose to consumers all annuity costs when recommending annuities is so significant that the National Association of Insurance Commissioners Suitability and Annuity Transaction Model Regulation expressly mandates that all insurers and producers to reasonably inform consumers about all applicable annuity fees, including fees on living benefit riders. The NAIC model regulation requires insurers and producers that sell annuities to have reasonable grounds for believing that a consumer has been reasonably informed of various features of the annuity, including but not limited to the following: potential surrender period and surrender charge, potential tax penalty if the consumer sells or surrenders the annuity, mortality and expense fees, investment advisory fees, potential charges for and features of riders, limitations on interest returns, insurance and investment components, market risk. Fees also impact whether an annuity with a living benefit rider is considered beneficial and or suitable for consumers. Insurers and their producers are mandated under the NAIC model regulation to have reasonable grounds for believing the following when recommending to a consumer the purchase of an annuity with a living benefit rider. The consumer would benefit from certain features of the variable annuity, such as living benefits, despite the fees imposed. The variable annuity as a whole, the underlying subaccounts to which funds are allocated, and the living benefit rider, including all annuity and rider fees, are suitable for the consumer based on that consumer's particular suitability information. Gotta love the lemon water. Examples of living benefit rider fees. The rider fee, along with the general annuity fee, is deducted each year beginning day one. These living benefit rider fees are commonly stated as a percentage, which varies depending on the type of living benefit rider purchased with the variable annuity. The rider also vary in how the rider fees are deducted from the annuity. Each rider lists and describes the cost of the rider as follows. The cost of the GLWB rider is usually 40 to 125 basis points, or 0.4% to 1.25% per year. The cost of the GMWB is typically 40 to 125. The typical charge for GMIB is commonly 75 to 100 basis points. So that's 0.75% to 1% per year, which can apply to the benefit base or the contract value according to the contract's terms. And then the cost of the GMAB rider is usually 50 to 110 points, or 0.5% to 1.1% annually. Living benefits and surrender charges. Most annuities levy some form of withdrawal or surrender charge on a partial and complete withdrawals, which often scales downward to zero as time goes on. As previously defined, surrender charges are those charges that apply when total or partial withdrawals are made from an annuity during the annuity's surrender charge period. However, guaranteed annuity annual withdrawals under a living benefit rider are typically not subject to surrender charges unless they exceed the free withdrawal amount during the surrender period as defined in the contract. Deducting living benefit rider fees. The fees on living benefit riders are deducted from the annuity's account value and calculated based on either the account value or the benefit base, depending on the terms of the annuity contract and rider. The annual fees on a variable annuity with living benefits will affect the return of the contract value and will impact the ability to capture any market-based step-ups. The following example helps illustrate not only how fees can affect the value of a variable annuity with living benefits, but also the importance of full disclosure of fees in a suitable annuity transaction. Actually, you know what? Let me send this out to my boy right quick. I know he probably want to see this. Let me see right quick. Raw. Come on, that's not it. Share this out. Copy this link. Share this to my man. God told me I've already got the line. You know what? While I'm at it, let me call my client since I got y'all on the line. I am in super work mode. Let me just see if and then we'll get back to the suitability. I just want to see if my client is got his issue dealt with. He might not be available at the moment. All good. I want to make sure. So see, part of being that financial advisor is you want to make sure that you work in the ecosystem with other professionals that your client is working with. So if there's a tax guy, if there's an investment guy, if there's an attorney, if there's I want to be working with them too, right? And just because I'm an investment advisor doesn't mean that I'm his investment guy. He might invest with someone else other than me, and I have no problem with that. Right? That's part of the business. Let's just see. Oh yeah, y'all, hold on. I just got to show y'all. Like I said, I'm making too much money from my company. They're taking me to Fogo de Chao Wednesday. Fogo de Chao Brazilian Steakhouse. Malk.
Yeah, so yeah, I messaged the guy as soon as I woke up and didn't get back to him. So I told him I'll be back my time around 3 because I think I'm an hour ahead. So when I get back to the crib around like 2:30, I'll hit him up again.
Okay.
And because I just don't want this guy to be intimidated by the news. I have a feeling he doesn't understand exactly what I'm doing.
You know what it is? So what happens is you've got some big numbers, right? We're talking over $1 million here, right? And so as soon as people start seeing millions of dollars, their eyes light up, right? And you got to remember, in that one account where one account itself has damn near $1 million, no, right? And that's not including what you've got coming in every month. If you include what you've got coming in annually just from your pension, we're talking 120 grand plus $750,000 plus the other 80 grand we got with the Charles plus. So people are like, oh, this guy's a millionaire. I want, so that's what it is. You're a millionaire, bro. You I know it's got to take some getting used to, but you're a millionaire, so you're being treated accordingly. And so, as soon as everybody sees you're a millionaire, soon to be multi-millionaire, it's exciting to them. I mean, shit, dude, you're just off your pension, you're a millionaire. In 10 years, you're over 1.2 mil just off of that. Right? Then, we haven't added, like I said, we got one account with almost $1 million in it. We've got some millions going on, brother. But yeah, if anything, let me know, because I thought about it this morning. I was like, nah, that's not like Malk. I didn't hear from him, so this guy must have not called him, because I know when something happens, you'd be like, yo, Lonzo. Okay. All right, then. Well, listen, I think we just lost service there. It's a client of mine who was out of the country. Well, I don't know if you can hear me, Mal. But listen, I gotta get running anyway. I'm gonna get back to business. I just wanted to make sure to touch base on that. Oh, okay. Yep. Yeah.
Yeah, my bad. I was in the elevator. See, I'm at the gym right now.
Okay.
But I told him, I said, look, when I get back, I'll hit you again. But you didn't hit me.
That's great. And this guy is in New York?
What is that?
This guy is in New York?
No, he's in Atlanta.
Okay.
Yeah, my sister. He was recommended to me by my sister because she did taxes with him.
Ah, okay. All right then. Well, hey, yeah. I mean, maybe he's just a little behind. I'm guessing, but because I was like, okay, I was like, it's getting lit, close to the afternoon. I know he said around 10, 11. So I was like, and I know Mal wouldn't leave me in the dark. So let me call and see what's going on. Hey, Mal, let me take this call.
Yeah, when I get out from the gym, I'll hit him back and I'll hit you, let you give you an update.
All right, cool.
What's going on.
Peace. This is Alonzo speaking. How can I help you?
Hey, Marcy, it's Jane.
Hey,
How you
what's
doing?
going on?
Not much. You got a quick minute?
I got a quick second.
Okay. So I sent you a couple of emails. Hopefully, you got them to both your emails.
Mm-hmm.
Just about some of the stuff you're talking about. Yes, I tried to send you like a template for just to give you some.
Oh yeah, I saw that.
Future. Okay. Also, there's some apps, and you have iPhone, right?
No, I don't, but I have Android.
Oh, okay. Okay, so you have this me. Well, go to the Google Play Store. I was trying to download an exercise daily walk app, but I couldn't do it and send it to you.
Yeah, I got it. It's Samsung Health. I here's the thing. When you asked me, I said, you know what? It ain't nothing to it but to do it. I got it. I already have been doing this stuff, but like you said last night when you was like, oh, I'm just chewing a piece of gum. That's what I ended up stopping. So I'm going to restart and being like, okay, well, I'm chewing a piece of gum, you know, or it's too stiff. And that's what I was recording, but I stopped recording it. But let me give you, actually, I'm glad you're on the line. It's funny you're talking about kicking Charles' butt. When we were at the dinner, I don't know if he noticed, but Liz Riley, who's our RVP, just decided to put out in the ether that they're looking for IBC managers in New York.
Which is basically what Charles does, like a whole group leader type of thing.
Yes, but no. I would be a general agent, manager, but in charge of the infinite banking concept. Because I know infinite banking. So they're looking for people who know it and they need young blood. Charles, you guys are too old. Jocelyn ain't listening to y'all. Y'all ain't on TikTok. I am. You know? And Jocelyn ain't, and listen, and I'm old too, because I can't figure out TikTok.
Now wait a minute, how old are you gonna be on the 18th?
40.
Okay. So you know it's major time to change. We're in a whole new decade.
Yeah.
Let me say this real quick. I'm not be calling you every day because you need an accountability partner. Okay.
Yeah.
And not to bug you, but to partner with you, and it could be a 5-minute call every morning. Okay?
That's exactly what I need.
Yeah, that's all we need. We don't need to spend no more time than that. It's gonna be a quick. Here's a daily scripture. Lift up your spirit. What are you doing? I need you to get out today. Take your walk around. If you can make it to the green, fine. If not, I know there's 3 blocks around 9 Square you can walk and go get your cappuccino, or even if that, because the cappuccino might not work for you. I know you don't need Pepsi. Okay, we already know that. But you're going to be 40. So I'm talking about improving your quality of life in 15 minutes a day. And definitely no more than a half an hour. The max you're going to spend doing all this to get your health right. Because the doctors ain't gonna do diddly. You've been doing them for years. They cannot help you. They cannot. Cannot.
Well, that, and I have real life clients who are going for me too. They like, Lonzo, we need you alive. You got to. I literally just got off of the phone with one of my clients who is having tax issues. He's a millionaire now, living in Brazil, and he was like, "Yo, Lonzo, why were you in the hospital?" He was like, because he said, yo, I got this guy who's right now with these tax. I need you to talk to him today because and I got millions of dollars and I don't trust nobody but you. And so I was like, okay, I'm sorry.
You haven't even begin. I mean, just think about, you can't even be intimate with your wife like you want to because these medications got you like 80-year-old man. You know what I'm saying? So you got too much knowledge and wisdom. The family needs you. We got next generation.
Yeah, I'm about to say. I'm trying to do that now. I need to actually get some information from Jocelyn because I'm trying to start Capri's college fund. And in order to...
So I'm gonna talk to her later. I know she's asleep right now because I don't know if you know, but Caitlin started his trucking, and so he's out on the road training. And I think he's out for like almost a week, and then he's home on the weekend. I don't know. They got different schedules. But anyway, they know because they know now they got for real life circumstance. It ain't just them two. They got a baby. They want to buy a house because they're paying. what, 2,500? I don't know what their rent is. It's too high. But they could definitely buy a house. And Jocelyn's working at 60% of her income on maternity leave, so she ain't got no money. And he's just starting. So they know now that their parents, and they do understand life change. And so but they don't want to be beat up around. I'm telling you, you got all kind of clients, but like your Brazilian friend said, and even family, even that. Let's say that you don't talk to any family members, and you don't talk to any of the clients you currently have. And I'm not telling you to do that. I'm just saying, listen, imagine if you started fresh today and put out your correspondence on who you are, what you do. Bottom line, right now, you have over 100 clients, like in a month.
Yeah.
Minimum.
Oh, absolutely.
Minimum, with starting from zero. Yeah. Just a minimum. Just from referrals and what you help 5 people to help 10 people, and all of a sudden you're blown up. But beyond that, first thing we got to do, and I know I have a biggest system. I'll tell you what I'm going through another time. That's not important right now. My goal is every day, every morning, I'm going to call you as an accountability partner. We only need 5 minutes to make So, did you walk today? No, I missed it. Got to do it. You can't have no excuses for not doing what you got to do. Because
but sometimes you do, and that's a big thing, is the accountability. Because if it's just you, sometimes you're like, oh well, and you'll give yourself an excuse.
Right. And distraction, because let me tell you, distractions will come up.
Yeah.
I need them every day, and you know they will. It's like, okay, well, first I got to make this email, and then you never step outside. Go get your coke and smoke.
Yeah. Yeah.
You're about to be, you're 40. Yeah. So all I was saying is, give me a week, and then give you to your birthday, and then you can say, hey, listen, I know your mom's worried, and Nikki's worried, and all that. It's like, you can't go into your 40s. You just cannot.
Yeah.
You can't. It's time to be done with that. Doctors can't help you. Your mama can't breastfeed you out of this. You understand what I'm saying?
Yeah.
Nikki can't love you out of this. Nobody can do this but you. But I definitely, because it's also going to help me to get on and every day, call you, love you, and say, hey, Lonzie, real quick, did you do your journal last night? And put it on. They got for the journals, by the way. I was going to say you handwrite a template, because
I ain't handwriting none. But TJ, let me get back with you.
Okay. All right. So do the app. Love you. I'll talk to you. Call me later tonight. Okay?
Will do.
All right. Love you.
Later. All right. So what is this? Oh, let me I gotta call him and find out about that. So now I'm going to do the unit test, and then once I finish the unit test, I have an article that I wanted to read to y'all. So let's do this unit test. So which of the following statements about the variable annuity living benefit riders is true? The GMWB is not guaranteed for the life of the contract owner. The GLWB rider is the same as the GMWB rider. The GMAB rider usually requires annuitization of the entire variable contract. The GLW rider guarantees that the contract owner can withdraw up to a certain percentage of the death benefit base each year, even if the contract value drops to zero, but only until total withdrawals equal or have exhausted the benefit base. I think I'm going to say D, but I'm going to click A, which is wrong. Oh, A is right. So question 2. Which of the following statements about variable annuity charges is true? A, all companies base their surrender charge on the total surrender value of the account, not the premium deposit. B, each subaccount in the company's separate account has an investment management fee, which pays for the professional investment management of the subaccount. C, most companies impose a surrender fee on any withdrawals, regardless of the year in which the withdrawal was made. Or D, variable annuities are likely to have lower costs and impose fewer kinds of charges than fixed annuities. B. No, I was right. So, question 3. Under a GLWB, salute to Rael in the building. And my fault, y'all. Yeah, I sped through the last, but my phone started ringing, and I realized that it's getting to be around noon. And I am management, as you guys can see, and so I do get a lot of phone calls from people on my team. I've stepped my game up since my first couple of years of being on the YouTube space, and hopefully I can step my game up more. Bring people, new blood into the industry who want to join the team of ADH Wealth Solutions, or who want to get into the industry, and gladly you can always become my client. So under a guaranteed lifetime withdrawal benefit rider purchased with a variable annuity, the owner can withdraw up to a specific percentage of a protected value each year for life, even if the contract value drops to zero and the total withdrawals exceed the protected value. What is the term used to describe this protected value? Benefit base. Sally owns a variable annuity with a living benefit rider that has a 7% surrender charge for contracts surrendered in the first year, 6% for the second year, and so on. In the contract's 8th year, Sally wants to cash out of her annuity, which has $200,000 contract value and a $250,000 benefit base. Which of the following statements is true? So usually that's a 7 to 10 year. Yeah. Oh shit! I clicked C. I mean D, not C. The answer was C, not D. Traditional fixed contracts vary from variable contracts in that a traditional contract are designed to last for the lifetime of the insured, where variable contracts are designed for the shorter term. Traditional fixed contracts are funded by separate accounts set up by the insurer, whereas variable contracts are entirely funded by the general assets of the insurer. Traditional fixed contracts require the company to assume the investment risk, where variable contracts pass the investment risk to the contract owner, or agents do not need to be licensed to sell variable contracts. C. All right, so I got one wrong. I had an 80%. I passed. Now let's see where I messed up. Here I clicked D instead of C. I meant to click C. Next, go to summary. Close window. So that's the end of that. So I'm going to speed through this. Let's see if I can speed through this. Suitability. See, I know the answers to this. I'm really just reading this stuff for you guys. Because this is FINRA, security, best interest. Oh, Prince Pierre, here we go. Regulation BI. Remember, everybody, a lot of these insurance people, when I talk about Regulation BI, they be like, oh, that's only for investments. No, Regulation BI is now for also insurance. No problem, Queena. Right? CRS, FINRA rule, what is that? 2090, diligence, updating customer information, essential facts, documenting information that's not provided, rule 2111, suitability, the investment profile. So let's look at suitability, and then I'm going to shut this down and go to my article. Had me a little cranberry juice. I added the lemon water and ice. Ooh! So the suitability rule expands the factors that you are required to ascertain before making a recommendation to a customer. Previously, you were required to make reasonable efforts to obtain information concerning a customer's financial status, tax status, investment objectives, and any other information considered to be reasonable when recommending a security. Under the suitability rule, you must collect specific information to create the customer's investor profile, and that includes the following information: their age, any other investments, their financial status and needs, their tax status, their investment objectives, their investment experience, their investment time horizon, their liquidity needs, their risk tolerance, and any other information that they might disclose to your firm in connection with the recommendation. Now, why is this important? Right? Why is this portion right here super important? Because anybody online telling you about these stocks, obviously they tell you this is not financial advice. But people like Wall Street Trapper and all these other fake motherfuckers have these courses. Yet the rules tell you this. Right? This is not like playing Hood Uno, where you create your own rules because it's in your house. This is an entire industry. Imagine you go to McDonald's and Wall Street Trapper is like, nah, son, you get the Big Mac like this. You got to make the Big Mac the blah, blah, blah. I teach you for $22 how to make the Big Mac. Just add Thousand Island dressing. Okay. Still not the Big Mac. It is why it's patented and pended and 2 all beef patties. And you're never going to get the exact. It might taste better than the Big Mac when you make it at home, but it's not going to taste exactly like the Big Mac. But the reason that this stuff is important, again, what does that say there? That you never hear these stocks. You might hear them talk about investment, their other investments. You might even hear them talk about their tax status, their objectives, or their experience. I have never, ever, ever heard none of these so-called do stocks with Larry, do stocks with Joe, mommy stock. None of them mention risk tolerance or investment horizon because they don't know what those are. So I'm going to stop that here. And I am going to pull up my article. My article, I just want to bring y'all back around to life insurance right quick. Actually, no, let's not do Fox 13. Let's do the Washington Post. So the Washington Post, February 21st, 2024, the Senate report blasts high-end life insurance plans as a $40 billion tax dodge. What? So specialized life insurance plans offered only to the wealthiest Americans are a vehicle for dodging billions in taxes, a Senate report released Wednesday charged. So, ladies and gentlemen, we keep talking this rich bullshit, especially in the black community, about how riches. We love the Democrats. Democrats ain't tell you to get life insurance. You know who told you to get life insurance? Ronald Reagan. Because Ronald Reagan, and this is why a lot of people love Reaganomics, was like, hey, life insurance is going to get you more money in the long run than Social Security that we have set up. Nah, we don't want it. 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 All right. And now the Democrats are going after life insurance. I wonder why. That's weird, right? I would find that very weird, except it's the reality of the situation. So that's going to be it for today, folks. Wipe ass, work in progress, every day and see success. And remember, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute. These was, matter of fact, hold on. Let me put this article in the chat. Because I think y'all need to see this. We always want to spend our tax dollars. But use strategy to keep more of the money. Matter of fact, I ain't done. Since I'm here, and I'm still here with it, let's look a little bit more at this article. Let's look at this article. Because this is interesting to me. I find it interesting. Also, oh, hold up, Rob. You see those AMG Petronas sneakers right there up top? The AMG Petronas Benz sneakers? I had to go ahead and buy me a pair. Hold on, let me see if I can show y'all these. I went and bought me a pair of the AMG Petronas Mercedes-Benz Pumas. They're the driving shoe. These shits, if you are a driving enthusiast and you own a Mercedes or a BMW or a Porsche, the Puma driving shoes, get with them. Oh my God. Yeah. And then, I got to get the rest of my Benz stuff. But see, we Benz boys over here. Let's go. Let's get back to this article really quickly, though, before I end this, because I've been going for almost 2.5 hours. I really want to start trying to do 3-hour lives because, shit, I know me and Rael, we done been seeing people sit around and talk for 3.5 hours about what's wrong with women. So I know we could spend 3.5 hours talking about what's going on in real life. So, though the high-end plan's tax advantages are legal, Democrats on the Senate Finance Committee blasted them as a booming tax dodge for the rich, sheltering up to $40 billion, and called for legislation restricting those plans as well as tax disclosure. Now, I want to go to Google on y'all. Right? Is life insurance, it says a tax shelter. Whole life insurance can avoid taxes by building cash value. What? Wait. So you mean these mofos who be telling you get term insurance, do investments, you could write it off, dollar cost averaging, because you're paying them more money. But I just went to Google on y'all. Investopedia says cut your tax bill with permanent life insurance. Can you use life insurance to avoid taxes? By purchasing life insurance, your clients can protect their families and potentially build policy cash values. At retirement, they can take tax-free loans or withdrawals on the cash value to supplement their retirement income, thus helping to minimize their taxes. And this is from Equitable. This is an insurance company, AXA, an insurance and investment company. How does this strategy work? I gotta stop now. I'll be doing a webinar on that. That's gonna be it, y'all. And now this is too much, bro. Salute to my people who initially supported me. Everyone who came out here, my first couple of 1,000 followers. I'm turning 40 this year. 2024 is my Black Mamba year. 2023, I guess you could call my Jordan LeBron year. I'm only getting better with time. And I've had a few gentlemen here who have said, listen, bro, we're tired of you wasting your time nickel and diamond. The type of stuff that you know, the knowledge that you have needs to be here. And there are people like Rael who value the information that we're given. Not just like Rael, like every single one of you who is here watching me today, who values this information. And I'm going to put a paywall on it, unfortunately, because there's too many people who keep coming in. And if folks are willing to pay Wall Street Trapper for his nonsensical courses, I use him as an example just because he's the largest name that it's like Kleenex. I don't have anything personally against him. But if we're going to listen to Wall Street Trapper, why not listen to a real Wall Street Trapper? I was literally on Wall Street. I actually was a trapper out there doing what people do in trapping, changed my life, and actually was on Wall Street. My office was 100 Broadway. If you take 2 lefts, the New York Stock Exchange is right there. 11 Broadway, you come out of that office and you can grab the brass bull by the balls. Americans think about that funny, but Asians, they grab the brass bull by the balls. And they don't think anything homosexual. Oh, that's suspect. You grabbing the bulls. Yes. It's a sign of virility, strength, and power. That's why they eat tiger bone soup. Anyway, it's your boy, the insurance junkie, your fiduciary fella, the all-star advisor, Alonzo Hall, just wiped and tapped on your head with another ADH wealth solution. Make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. With that being said, ladies and gentlemen, wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. And remember, folks, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.